This is part 3 of the Chapter 10 lecture series on bond retirements. Let's get started. A bond is retired when the company buys back or redeems the bond. If the bonds are retired at maturity, the company would simply debit bonds payable for the face value and credit cash for the face value. The entry is slightly more complex if the redemption happens before maturity. This is known as early redemption and is allowed on callable bonds that we discussed earlier. If the bonds are retired before maturity, we must eliminate the carrying value of the bonds, record the cash paid, and recognize any gain or loss on redemption. The carrying value is equal to the bond's face value if the bonds were originally issued at face value. If the bonds were originally issued at a premium, the carrying value is the face value plus the bond premium. If the bonds were originally issued at a discount, the carrying value is the face value minus the bond discount. We will focus on early redemption of bonds originally issued at face value. The gain or loss on redemption is simply calculated by subtracting cash paid from the carrying value of the bonds. If the carrying value is greater than the cash paid, you will have a gain on redemption. And if the carrying value is less than the cash paid, you will have a loss on redemption. Let's look at an example. The following accounts are taken from Barnaby Corporation's balance sheet at December 31st, 2013. In the current liability section, we have bond interest payable of $128,000, and in the long-term liability section, we have bonds payable of $1.6 million. The bonds carry a stated rate of 8%, and the maturity date is January 1st, 2017. Interest is payable annually on January 1st. The bonds are callable on any annual interest date. Again, this means that Barnaby Corporation can redeem the bonds before January 1st, 2017 if they so choose. A asks us to journalize the payment of the bond interest on January 1st, 2014. We should first calculate the amount of interest to be paid, which is calculated by multiplying the face value of $1.6 million times the stated rate of 8%, which is $128,000. As you can see from the partial current liabilities section, the interest due on January 1st, 2014 was accrued at December 31st, 2013, as indicated in the bond interest payable account. So, the entry on January 1st, 14, when the interest is paid, would involve a debit to bond interest payable and a credit to cash for $128,000. B asks us to assume that on January 1st, 2014, after paying interest, Barnaby Corporation calls or redeems bonds having a face value of $400,000. The call price is $105. The call price determines the amount the company will pay to the bondholders to redeem the bonds early. It is stated as a percentage of face value as similar to the bond price. So, the total cash paid by Barnaby to redeem these bonds early is the face value of $400,000 times the call price of $1.05, which is $420,000. This means that Barnaby is paying these bondholders an additional $20,000 to redeem the bonds early. The reason a corporation would be willing to pay more than face value is because by redeeming these bonds early, the bondholders are missing out on 3 years of interest, 2015 through 2017. This extra cash is basically trying to make up for some of that lost interest. The entry to redeem the bonds must remove the carrying value of the bonds, which is the face value in this example because there is no premium or discount. It must also record the cash paid of $420,000, and finally, it must record the gain or loss on redemption, which again is the carrying value minus cash paid. The carrying value is $400,000 and the cash paid is $420,000, so the numeric amount of the gain or loss is $20,000. The carrying value is less than the cash paid, so it is a loss. In the entry, we would debit bonds payable for the face value of $400,000 to remove those bonds from the books. We would debit loss on redemption for $20,000, and we would credit cash for $420,000. Lastly, it asks us to prepare the adjusting entry on December 31st, 2014 to accrue the interest on the remaining bonds. As you can see from the T account, the face value of the remaining bonds is $1.2 million. The interest owed on these bonds is $1.2 million times the coupon rate of 8%, which is $96,000. The accrual entry is just like the interest accrual entry that we learned in Chapter 4 and we discussed earlier in Chapter 10. We would debit interest expense for $96,000 to recognize the incurrence of the expense, and we would credit bond interest payable to recognize the fact that we owe bondholders interest. This interest of $96,000 would be paid on the following day, January 1st, 2015. This completes Part 3 of the Chapter 10 lecture series on bond retirements. Have a great day!